Stop whatever you're doing for the next few minutes, because the global economy may be standing on the edge of something it has seen before, and every single time it happened, it ended badly. This isn't just another headline. This is about a potential shockwave that could hit your wallet, your investments, and the entire global financial system. In the last 72 hours, tensions between the United States, Israel, and Iran have escalated sharply. Military alerts are up. Regional assets have been repositioned, and right now, oil traders are watching one thing and one thing only: the Strait of Hormuz. For those who don't know, this is the world's most important oil choke point. It's a narrow 21-mile strip of water, but through it flows nearly 20 million barrels of oil every single day. That's roughly 20% of global liquid petroleum consumption. Think of it as the main artery for the world's energy supply. If that critical artery is disrupted, even partially, markets don't wait for confirmation. They reprice immediately, and they reprice violently. Now, why should this feel so familiar and so dangerous? Because history shows us a clear pattern. There is a four-stage energy shock cycle that has repeated itself for the last 50 years. Stage 1 is dependency. The world builds its entire economy around the assumption of cheap, abundant oil. We've been living in this stage for years. Stage 2 is concentration. A huge portion of that oil flows through one single, vulnerable choke point, the Persian Gulf and its exit, the Strait of Hormuz. That's our current reality. Stage 3 is escalation. A geopolitical event suddenly threatens that choke point. That's what we are witnessing right now. And Stage 4 is the cascade. Oil prices spike, inflation returns with a vengeance, and markets fall hard. We've seen this exact pattern play out before. In 1973, the oil embargo sent prices quadrupling, leading to gas lines and a deep recession. We saw it again in 1979 with the Iranian Revolution. Oil prices more than doubled. We saw it in 1990 when Iraq invaded Kuwait. Each and every time, even a single-digit percentage supply disruption was enough to cause oil prices to double or even more. The global economy is incredibly sensitive to these shocks. So, let's look at where we are right now. As of the last market close, Brent crude oil, the international benchmark, was trading in the low $70s per barrel. But don't let that number fool you. Behind the scenes, major investment banks and energy analysts have already begun modeling what happens next. Their models are showing potential prices of $90, $100, even $110 per barrel under a sustained Hormuz disruption scenario. Let's just do the basic math on that to understand the direct impact. A good rule of thumb here in the US is that every $10 increase in the price of a barrel of oil adds roughly 25 cents per gallon at the pump. So, if oil jumps from $70 to $100, a $30 increase, that's an extra 75 cents you'll pay for every gallon of gas. Your trip to the gas station goes from, say, $3 a gallon to nearly $4 almost overnight. That hurts. But gasoline isn't even the real story. The real danger is what happens to everything else. Diesel fuel powers the trucks that deliver everything to our stores. Without it, supply chains grind to a halt. The cost of producing fertilizer, which is essential for growing our food, is directly tied to the price of natural gas, which moves with oil. Airlines hedge their jet fuel months in advance, but a sustained price spike will eventually get passed on to you in the form of higher ticket prices. An energy shock doesn't just stay in the energy sector. It bleeds into food prices. It bleeds into transportation costs. It bleeds into manufacturing. It has the power to reignite inflation expectations across the entire economy, just when we thought we were getting it under control. And here's the really dangerous part, the variable that makes this time potentially different and potentially worse. Central banks, like the Federal Reserve, are already in a very fragile position. They have spent the last 2 years fighting runaway inflation, and they haven't fully won that battle yet. Inflation is still above their target. Government debt levels around the world are at historic, eye-watering highs, and the savings cushions that families built up are thinning out or gone completely. An oil spike hitting this kind of environment doesn't just hurt, it squeezes the entire global economy from all sides. Companies face higher costs, consumers have less money to spend, and governments have less room to maneuver. So, as we head into a new week, here are the three main scenarios that markets are trying to price in right now. Scenario 1 is the optimistic case. The current escalation stabilizes within a few days. The saber-rattling quiets down. In this scenario, oil might spike briefly on fear, but it would then retreat back down as tensions ease. This would be the best possible outcome. Scenario 2 is the messy middle ground. Shipping in the region doesn't stop, but it hesitates. Insurance premiums for oil tankers sailing through the Gulf skyrocket, as they did during previous periods of tension. This adds a cost to every barrel of oil that leaves the region. In this scenario, oil prices don't necessarily go to the moon, but they embed a $15 to $25 geopolitical risk premium for months to come. So instead of $70 oil, we might be looking at a new normal of $85 to $95 oil, which would keep inflation stubbornly high and weigh on economic growth. And then there's scenario 3, the one that everyone fears. Transit through the Strait of Hormuz becomes materially disrupted. This doesn't even have to be a full blockade. Even a partial obstruction, or a series of incidents that make safe passage impossible, could remove millions of barrels from daily global supply. This is the point when $100 oil stops being a scary headline and becomes the base case scenario for Wall Street. And history shows us a very clear warning sign. When oil stays above $95 a barrel for more than 30 consecutive days, the risk of a global recession climbs sharply. This isn't about spreading panic. This is just arithmetic. The modern global economy still runs on oil, and a huge, irreplaceable amount of that oil still runs through the Strait of Hormuz. Monday's market open may not be an immediate crash, but it may be the moment that markets finally start to wake up and reprice this enormous geopolitical risk properly. The complacency we've seen for months could evaporate in a single trading session. So, what should you watch? Don't just watch the headlines. Watch the underlying data. Watch the tanker tracking data to see if ships are being rerouted away from the Gulf. Watch for official statements from Saudi Arabia and other major producers about their export levels. And crucially, watch the insurance rates for shipping, the so-called war risk premiums. That's often the first place you'll see real fear manifest. Remember, energy shocks don't announce themselves politely. They don't send an invitation. They cascade through the system. And once stage 4, the cascade begins. It moves much, much faster than the news cycle can keep up with. We'll be tracking this minute by minute. Thanks for watching. Make sure you subscribe and turn on notifications for more updates as this critical situation develops. Stay safe and stay informed.